大家好，我是 Augustine， 很幸亏你们今天用宝贵的星期五晚上来听我们的讲座。因为我中文表达的能力有限，所以之后的 presentation 是我英文来讲的。谢谢。Quick background, my name is Augustine. I spent about 20 years in the investment markets, first 10 years in Goldman Sachs, basically trading any sort of US-based products you could imagine. Things you probably saw in movies, LIBOR swaps, mortgage backs, I sort of did all of that. And then the last 7 or 8 years, I had joined a family office to be their CIO, focusing more on the private investment side. And then over the last 2 years, I joined a startup technology company called SignalPlus, where my friends are also here. I'm a partner and CFO of the company. We're focused on developing a professional software terminal from former Wall Street and e-commerce tech professionals to focus on digital assets. So today's topic is on the macroeconomy, but with a very heavy focus on interest rates, because I think that's an underappreciated topic, given how important it is to the current economy. So I know schools have their own definitions of what an interest rate is, and obviously here in the university, but I was always taught to think of interest rates in a different way. I think of interest rates as the price of money. So what does that mean? Money itself actually has a price tag. If you think about what capitalism is, it's actually about hoarding assets and resources, not just having the biggest number on the currency, because that number fluctuates. So money itself has a price tag, and that is actually basically reflected in what an interest rate is. So on that same thinking, what is inflation? You can think of it as prices going up, but I like to think of inflation as a government tax on your savings. What does that mean? If you make money and you leave it at a bank and you don't do anything and inflation's high, you've effectively been taxed. That's really all there is. So if you think of a central bank, they have an ability to manipulate where interest rates are, which is what the price of money is. And also from their actions, they can actually influence how much inflation comes in, meaning how much they can actually tax you. So as we know, taxes is probably one of the best ways to influence how consumers will react. For example, dividend versus interest rate policies, property tax, inheritance tax, etc. So if an organization has an ability to change how much your money is worth, as well as to change how much you're taxed, they're basically able to influence how you're going to consume and invest without actually doing anything. So that's why interest rates, in my mind, is very, very important. So we just talked about number one of how interest rates affect the economy, whether you want to save versus spending. There's a few other ones. There's obviously a lot, but I'll just talk about a few quickly. One is how easy it is for you to borrow money. That's pretty simple. Lower interest rates, you can afford to borrow more. The third one, government spending. As we all know, most of our governments have no money. They borrow a lot of the extra balances. So lower interest rates allow governments to borrow more, which allows them to spend more back on the economy. And last thing, asset pricing. As we know, I just discussed, interest rate is the price of money. So if I affect interest rate and that affects money, and money is used to price assets, indirectly you can affect whether asset prices go up or down by changing interest rates. So this is a chart that probably many of you have seen before. It's a chart of US consumption. As we know, Americans like to spend. 70% roughly of US GDP is consumption. But what's actually remarkable is it is pretty much a straight line. There are very little changes in how US consumption changes, even in a recession and even in COVID. You can see how quickly it bounces back. Now, we talked about why you will choose to save versus spend. So when I was young, my parents always taught me the way to move higher in life is to save and afford the things you want to afford. Well, that made sense in the 1980s and 1990s when the gray bar, which is basically your savings rate, was at or higher than inflation. What does that mean? Going back to the analogy, it means that the price of your money was worth more than the tax on your savings. So of course you save. It makes sense. You keep your money, it earns more than the inflation, and you will probably do well after a few years. But that's pretty much changed since the 2000, where you're basically not getting any interest rates, and your inflation has been pretty high, which means you're actually punished or taxed for living within your means. So for a rational person, I mean, spending is fun, shopping is fun, and we all get that. But if you're taxed for saving your money and not doing anything, what would your rational thing to do? Well, what is your rational thing? You spend, you invest. That's absolutely what a normal person actually should do, especially for the younger generation. And we saw exactly actually just that. As the chart on the left, as the interest rates have gone down since the 1980s, if you look at how US households have actually allocated their assets, cash has gone down from, call it 20-odd% down to 17 as rates have gone lower. Debt has actually gone down as a percentage of their assets, which might be surprising. We know Americans have been spending a lot, but as a percentage of their balance sheet, their debt ratios have actually dropped a lot because their assets have become so valuable. And that's reflected in equities. Americans now put about 40% of their total wealth in equities, which is, I think, quite high for most Asian countries. And that's a reflection of how low interest rates have pushed people to invest. Next part on GDP. This is a fancy chart, something called a credit impulse versus GDP. The orange chart is something what we call a credit impulse, which effectively is how much credit is being created in the economy. If you look sort of squint a little bit, the orange line tends to lead the blue line. What does that mean? Credit actually drives how the economy works. So if you look at what happened during COVID, obviously GDP collapsed. We saw how the orange line has spiked, which is basically central banks everywhere printing money, throwing money at the economy, trying to save it, and then the blue line basically bounced afterwards. Same thing during Lehman, and that one, as everybody probably knows, there was no credit creation in the US, so credit basically collapsed, which led to the economy to collapse. And then QE started, and all the plans started, and the credit curve came back, so did GDP. So credit is a massive driver of actually how GDP works. And this one is on consumer debt. Again, so on the chart on the left, you'll probably see this before. That's the US consumer debt broken down into mortgages and different types. But what's interesting is actually the chart here on the right, something called debt service ratio. For those of you in accounting, you probably know this ratio very well, which is how much of your cash flow is being used to pay back interest payments versus how much you're making. So you would think that given the debt chart, the debt rise on the left, the number on there will be going higher. But actually, no. As a percentage of how much the US consumer is making in income, the debt service has hit basically historical lows. It's at 9% of their disposable income. Again, that's a combination of their assets going higher, and most importantly, their jobs are paying well. As you probably read, the US job economy are doing very, very well. So, government, again, similar chart. The chart on the left is how much the US government spends. It's basically an astronomical chart. The number keeps going higher. This is an old data, 2022. Given the debt ceiling rise, that number on the left will go even higher. But again, on the right, what's remarkable is the green line, the interest cost. This is the same line as we saw for the consumers, but for a government level. As an interest divided by GDP for the US economy, it's actually been pretty flat over the past 10 to 12 years, even though they're basically borrowing astronomical figures, which means as they're borrowing more, they're actually not managing the denominator so much. Modern finance, the management tends to happen on the service cost, which is, are you able to pay the debt on a month-to-month basis, and are you using the debt to purchase assets or build the economy effectively? That's why these modern economies are allowed to basically rack up the debt without running into any problems. So I mentioned this, interest rates drives valuation multiples. This is a chart on where US real yields are. Real yields are basically interest rates adjusted by inflation versus the inverted part is the price earnings multiple for the S&P 500. Pretty much the same line over each other. As interest rates go to zero, you're happy to pay more for price earnings multiple for S&P because money is worthless. The price of money is worthless. As interest rates go higher, all of a sudden your money is worth a lot. Then all of a sudden you're less willing to pay so much for the equity. So again, FOMO or fear of missing out happens a lot more when rates are zero. But as you can see at the very, very end here, the Fed has raised rates a lot in recent times, which is why 2022 we saw a big drawdown in the S&P. But ultimately, it's not a month-to-month, day-to-day correlation. But over the long run, interest rates determine how much people are generally willing to pay for assets. This is pretty much the same chart, but on real estate, it's pretty self-explanatory. As rates go lower, people pay more for real estate. The chart on the left, that's pretty much as you would expect without even attending this class, which is why real estate has done so well, at least not the last 2 years, but basically since the 2010s. This one is more interesting. So we talk about animal behavior or driving your behavior from what interest rates do. This is a chart of how much risk people are willing to take as interest rate changes. And what it's telling you is as rates go lower, consumers, investors naturally make more allocations to risky assets. And again, that makes sense because you're not getting a lot of money sitting in the bank. You're willing to take more risks. So if you look at pensions, which is basically as safe as a manager you can get in the US, they're managing national savings. The allocation they have to equities, alternative assets, such as private equity, has gone up a lot since the 1979s or 69s, all the way to the last decades. Now, about 2/3 of even the pension allocations are to equities or alternative assets. Again, these are retirement accounts for our US consumers. So you can see how low rates actually drive investors to make long-term asset allocation decisions. So this is a very quick chart for those of you who've never seen how US bonds and rates are traded. This is a very typical screenshot. You can almost think of it as like an equity chart, but it just has different coupons and maturities. The blue boxes are basically yields, so we quote bonds off yields. We never quote bonds off price, we quote bonds off yield, because prices don't make any sense depending on what the coupons are. We always think in terms of yields. So very quickly, you've probably heard about the yield curve. What is it and why does it matter? The yield curve is basically a curve measuring how willing you are to lend money over different terms. Naturally, you would think that if I lend money for longer term, it should cost more than shorter term because you're losing your money. That's very natural. The spread of that is called a term premium, which is, if you imagine your friend wants to borrow money from you for a week, that's one rate. If he wants to borrow for 5 years or 10 years, that's obviously a very different rate. And the yield curve itself has a lot of economic signals for the macroeconomy. I didn't show this here, but actually I did show it here. Actually, you can see here it's a bit older. Again, the data is a little bit old, but you can see that the yield curve is inverted. The 30-year is 379, the 2-year is 425. So that is normally not healthy. Why would you lend money for longer term at lower rates than shorter term? In the US Treasuries case, because people assume Treasuries to be risk-free, there's no risk for US default. That basically just tells you that the market is expecting the economy to slow down, and thus the Fed has to cut rates. And since longer-term rates are basically mathematically equivalent to the string of spot rates, so if forward rates are lower, it means that the path of the interest rates must be going lower. As you can see on this chart, right, a little bit fancy. That's probably more for your quantitative finance class. But effectively, the point is spot rates are a function of forward rates. And here, this is probably quoted a lot in newspapers. The yield curve is often used as a recession signal for how well the economy is going to do. Based on where the yield curve is right now, the Fed forecast, so to speak, implies a high chance of recession in the next 18 to 24 months. But again, this is just one indicator. It's not the only indicator. There's a lot more. But this you will see to get quoted a lot on newspapers because the yield curve is a very effective and very liquid instrument. So we keep talking about these rates, all these yields. How big is the actual bond market? What if it's mispriced? How important is it? To give you a rough sense, as of a couple of years ago, and now the number's a lot bigger now because we keep issuing more debt, the total issued global fixed income is 127 trillion. That's a lot of zeros. And of that 127 trillion, which is, by the way, roughly equivalent to the global equity market cap, for the longest time, we're actually bigger than equities in terms of fixed income. Of that 127 trillion, about 40% is US debt. So about 54 trillion is US debt. And of that 50 trillion, 40% is the government bonds, 25% is mortgages. That's actually huge. If you think about how big the US mortgage bond market is, that's bigger than most countries' total sovereign debt. So the US housing mortgage market, it is so big and so liquid, which is why the US housing market is always so sensitive to react to different things, because it is a very liquid, very looked after market, and there's a lot of supply and demand for where rates are, and it's rarely mispriced. That's why the US housing market is so strong, so useful to the consumer, and it's rarely mispriced. So we've talked a lot about these issuances, but who on earth are buying these bonds? I mean, there's a lot of trillions out there, right? I know, again, we talk a lot about central banks, foreign governments actually lending money to the US. In recent times, that's actually quite small. The actual bigger buyers of these bonds are commercial banks, pensions, foreign private accounts, households, bond funds, and the own central banks through QE. Central banks are actually buying back their own bonds. You can actually see a breakdown roughly in these two charts. So over here on the right, it might be a little hard to see, but basically it breaks your buyers up into the Fed, foreign officials, households, etc. Foreign official, which is foreign central banks, is the second category. It's tiny. It's actually so small you can barely see it. The two boxes that I've boxed are households and MMFs, which is money market funds. So to many people's surprise, US households actually buy a lot of US debt. They don't save necessarily in the bank accounts. They save via buying US debt. That's just another form of saving. MMFs are money market funds. That's basically the cash equivalent for an Apple or an Amazon or Google. They're not going to leave $10 billion in a bank account because that's not federally insured. What they would do is they would take their massive cash balance sheet like Apple and they will roll it over in money market funds, because it's the same as it's basically T+1 or T+5 liquidity. It's kind of like cash, and you get extra yield, and it's very safe. So what I'm trying to say here is the US bond market is very, very liquid, and it basically has buyers from every space you can imagine, and the impact of any one particular buyer is actually somewhat minimal. The biggest impact in the last few years is actually the Fed themselves, because they were buying so much in QE. And we're going to talk about QE a little bit later, but the point on this is not one single counterparty can affect US bond rates on their own. In terms of foreign ownership, this is a very rough estimate from Bloomberg and Reuters of how much debt of each country is owned by foreigners. Now, obviously US, as the biggest market at 50 trillion, it also has the largest foreign bond ownership. So you might think of it as, okay, that just means they're at the mercy of foreign investors. They're the ones lending the US money. But it's kind of a two-way street. People are actually giving money to the US because it is by far the most liquid market, and they have trust in it, and it's very liquid, and it's a good source of capital. So as much as they need to borrow money to fund their own deficits, investors are also happy to give them the money because they think it's to be safe. So that international representation is usually a good thing in terms of the macroeconomy, because it basically tells you that foreign investors are happy to invest in your country. So let's take a step back and talk a little bit about the Fed and the Treasury. Their functions are very similar to the PBOC versus MOF in China. The major takeaway I would say from this is the Treasury is like your accountant. They're the ones who set the budgets, they spend, and they actually print your money. The Fed does not print money. I know people always say the Fed cannot print money. The Treasury prints money. What the Fed can do is they set monetary policy. So they can change how much your money is worth from interest rates. They determine how much money is floating around in circulation, and they're what we call the lender of last resort. We saw that in March with the Silicon Valley Bank blow up and other stuff. What the Fed can do is they can extend their balance sheet and basically lend money to different regional banks as a loan to basically cover shortfalls as a lender of last resort. They have also done it in QE, which is actually an asset swap, not money printing, which we'll cover a bit later. But I just kind of bring this up because a lot of people kind of misuse the terms about assuming that as soon as they do QE, there's extra money circulation going into the economy. which means it must be inflationary. That's actually not true. If you really want the helicopter money, the Treasury has to do it. They literally have to go actually print the cash and give it to every single person. The Fed cannot do unsterilized, what we call unsterilized expansion. That's not what they're allowed to do. So looking at the Treasury balance, this is a typical balance sheet, how the US makes their money and spends their money. Sources of financing, you'll see that most US spends more than they have. They're borrowing about $1 trillion in this chart. About 45% of that comes from income tax. That's a lot of money. And that's also why the US IRS is so scary and so powerful, because that literally is the largest source of their income. What's also interesting, though, is corporate tax. If you think about all the big companies in the US, they literally have the world's largest companies. They only pay 7%. US corporates don't pay any taxes. They're very, very friendly, which is why all the big enterprises like to go to the US, because despite what they say, they are extremely favorable to corporations, and explains why all the big companies are listed there. Again, the chart on the bottom right here is probably what a lot of people talk about, which is, oh no, their debt to GDP has gone up to kind of 1950s, but that's debt to GDP. Remember what we discussed earlier, where the service ratio is very low. So those are actually contradictory. And which one's right, which one's wrong? We'll touch on that a little bit later. But I would just generally say be very aware of just using a debt to GDP number as saying that a country is in trouble, same as Japan, same as a lot of places, because the reality is a little bit more complicated than a single number. And this, you probably learn about this in your classes. I won't touch on it too much. But generally, as a principle, economic principle, central banks can only manage two of these three policy pillars. There are free capital flow, a fixed exchange rate, and sovereign monetary policy. You can't manage all three. You must give one up. So developed markets generally prefer to keep their capital flows open, and they prefer to set their own monetary policy, which means they allow the FX rates to adjust, which is why you don't usually hear the US or Europe, or Australia or Canada talk about fixing their exchange rate. They've decided to let the market do that one. Whereas in emerging markets, because we tend to be more export-based, which means it's FX-driven. As our FX gets cheaper, we can sell our goods more to the developed economies. We tend to want to control our FX rates. But we also want to control our monetary policy. So what do we have to sacrifice? Capital flow, which is why most emerging markets have controlled capital flows. That's the main difference between how economies work between developed world and the emerging markets world. Do you let FX flow, or do you let capital flow? You can't control all three. This is a section on a fractional banking system. It's a bit academic and boring. I won't kind of bore you guys with this. But the main takeaway is you probably know, for each dollar you put into the banking system, the output to the economy is more than $1, because it gets lent and relent in the banking system a number of times. That multiply is what we call the velocity of money, and is actually ultimately what drives inflation. It's not how much money you put in to the system that drives inflation. It's how many times that money gets lent and relent. That multiplier is actually what drives inflation, and it's called money velocity. I'll have a chart on this later, which will hopefully clarify that. So what's the Fed's job? What are they actually supposed to do? So they'll have three mandates, but usually in reality, people only talk about two mandates, the dual mandate, which is maximizing employment and stabilizing prices. Basically, make sure everybody has jobs and make sure prices don't go crazy. That's basically their job. And they can do it through one of three ways. The discount rate, which is what everyone talks about, cutting rates or not cutting rates. Second is what we call open market operations, basically QE. They have other stuff, but it's really QE. And the third one is reserve requirements, which I think China will use that a lot more for RRR. US, much less so. They're much more focused on 1 and 2. We are going to focus a bit more on 1 today, given our time. So this is a chart of the S&P, which is yellow, versus the white chart, which is the Fed rates. Only one takeaway, which is the Fed takes a long time to hike generally, but they cut rates very fast. As soon as the S&P drops, they tend to cut rates, meaning the Fed looks at the equity market as one input to their policy. And I'll touch on this again later. There is one exception, which is what's happened in the last 12 months. Again, this is 4%. We've gone to 5% plus now. We've hiked rates very, very fast in the past 2 years, much more than what the market expected, because inflation, for once, is actually finally coming back. And again, I'll touch a bit on this, but currently we're in a very different macro regime than any time we've seen since the late 1980s. And what is this chart? The takeaway here is you can think of interest rate forecast as almost like a betting market. The market is very focused on what the Fed's going to do at the next meeting or the meetings afterwards. Literally every word they say, everything they do, everything they publish, the markets are adjusting odds on what they're going to do in the upcoming meetings. Again, very much like like a sports team, you're betting on which team's going to score, which team's going to win. It's a very, very, very focused market on what they're going to do immediately. But that's great. That's on the short term of the yield curve. What if the Fed goes, I don't want to just influence the short term. That's great. I can talk and do all that. How can I influence the long-term rate as well? Because I'm greedy. I want to influence, remember, I want to influence the price of money. I want to influence how you behave. How can I do that not just on the short end, but also on the long end? That's where QE came in. QE is not money printing. QE is their ability to manipulate your sentiment on long-term interest rates. So I'll have an example on the next chart, but QE is an asset swap. As you can see, through COVID, everybody threw kind of the kitchen sink at it, and the balance sheets have expanded a lot in 2020, 22, 23. But what is actually QE? This chart, bear with me here a little bit. It's a little bit complicated, but it's very important to know. So, I've labeled 1, 2, 3. These are the steps. So let's actually go through what happens to an accounting statement when you do QE. Step 1, the Federal Reserve balance sheet on the top. Okay, I'm going to go to QE now. I'm going to buy some treasury bonds. So their assets will go up by 100. Their liabilities will also go up by 100. Net, it's 0. There's no net impact, but there's a gross impact. So what are these liabilities do? They're basically calling a JP Morgan, a Citibank, a Goldman Sachs, whoever it might be, and say like, hey, listen, I'm doing QE. Step 1, I'm going to buy 100 of your treasuries. So the bank primary dealer here at the bottom loses $100 of treasuries. In return, I'm going to credit your reserves because you leave money in my bank anyway, at the central bank. I'm going to say, I take your treasuries, but now you get $100 sitting as reserves. Great. So net, 0 impact, 0 net impact, plus 100 gross impact. But the bank goes, well, hold on a second. I want my treasuries. I don't want to lose it. So step 2, the bank goes to the market or to another person and say, hold on a second, I want these treasuries back. So I'm going to go buy $100 worth of treasuries. In return, I'm going to give $100 to somebody else who sells. That's where step 3 comes in, the most important part. The ultimate person who sells the final treasuries, the blue section, to the bank buyer now lost $100 of treasuries, but gains $100 of cash. What that seller does with this cash ultimately is actually what drives how much inflation happens in the economy. So if that person leaves it in cash, nothing actually happens. We've done nothing. You've just created $100 in deposits where the Fed switched it for the ultimate seller. There's no actual inflation. I'll come back on this point a little bit later with some more examples, but this is something I wanted to touch on early to put in your mind because it is very important to understand that quantitative easing, it's not money printing. You are influencing behavior by swapping assets. And you can actually see that from CPI. The blue chart is the expansion in the Fed's balance sheet. It's gone from $1 trillion back in 2006, 2007 to $9 trillion or 10, actually over that now, which is 35% of US GDP. That's massive. The white line is CPI. Hasn't done much. You would think if you printed that much money, 35% of GDP into the economy, you would get a massive explosion in CPI, right? It hasn't happened. So why hasn't that happened? I'll leave you with that. Now, again, I'll cover that a bit later. But again, it is not outright money printing. If it was, you should see the CPI spike. So, taking a step back, what does the Fed actually look at when they decide to do QE or not do QE or do interest rates? Generally, if you remember the dual mandate, they basically mostly care about jobs. They mostly care about inflation. So CPI, PCE, which is sort of like a CPI, and non-farm payrolls are basically the biggest market-moving events for the Fed. US ISM is also very important because manufacturing is a big part of the US economy. People look at that a lot for jobs. And retail sales and housing starts are a reflection of how the US consumer is doing. So those are all kind of your first tier economic stats that the Fed cares about, with CPI and jobs and PCE being at the very, very top. And in terms of market pricings, how do you know what the market is pricing in terms of Fed expectations? You can see that from the yield curve, from stuff called inflation break-evens. What that means is inflation is actually traded. You can actually see and trade what people are expecting for inflation. You can trade almost anything in the US debt market. Everything almost has a price. Stock prices, I mentioned, the Fed looks at whether stocks are going up or down to decide what they want to do. And of course, corporates, are they making money? Are they defaulting? Credit availability. That's also the stuff that the Fed will look at as they make their decisions. Which takes me to this concept of financial conditions. You say, well, hold on, that's a lot of things they got to think about to decide whether they want to ease or hike. I thought it was just inflation or jobs. So there is a whole study, and again, probably you can do that in your PhD classes, a whole econometrics index of a concept of financial conditions, which you can think of as how easy is money in the US economy. It combines where the interest rates are, short-term interest rates. It combines where the 10-year interest rates are. It combines corporate spreads, which is basically how much corporates have to borrow on top of interest rates, the S&P, and the US dollar. So there's a whole study of combining all these factors into an actual index on the left. This one here is done by Goldman, but I think most of the banks have something very similar. So this is not a one, or this is kind of a mean reverting index. And that's these studies on econometrics. The Fed will look at it to gauge, are we too tight or are we too loose? So if you look at if you look at the 2020, you see this massive spike. That was COVID. From the Fed's perspective, COVID was a massive tightening event, which means they have to do a lot more QE, a lot more Fed eases, which they did, but they overdid it. 2022, conditions went too easy, so much more than before, where the Fed basically had to say, okay, COVID is no longer going to wipe out the human race. We're going to be around. Let's step it back, which is why they went on this massive hiking campaign, and we've now stabilized it back. So it's not a simple 1 or 0 of how they look at indicators. It's a moving variable. It's quite complex. But the point is, they do look at these indices. All these contribute to what they actually want to do. And most economic forecasters would tell you economic growth is forecasted based on how easy liquidity is. So this chart here on the right will basically tell you, based on what people think how much credit is available, GDP is going to go up and down based on that. So it goes back to the original point about the US economy is highly reflective of how easy money is, or how easy it is to borrow money in the economy. So this here will try to take some of the concepts I just discussed and to try to kind of apply it in slightly more practical ways to make it slightly more interesting. So I know a lot of people think about the US as being very laissez-faire, very cowboy in expanding their credit as a percentage of the GDP. But that's actually really not the case. If you look at the entire world, Europe, Japan, US, China, EM, everybody has been creating a lot of credit versus GDP. In fact, for us here in China, the red line here, we've created more credit as a percentage of our GDP more than anybody else. Even Japan, who people generally think are not creating credit, the dotted line here on the left, since 2017, 18, I would say, they've created as much credit as percentage of GDP as US and Europe. Basically, the entire world is addicted to credit. It's not a US story. It is a global, modern monetary story. Most of our GDP is borrowed because credit allows us to leverage, do whatever we do. It is simply something that is a part of modern economics. So is borrowing good or is borrowing actually bad? My view is it's neutral. It depends what you use the money for. If you borrowed and you went and did silly things with it, that's non-productive and probably that's a waste. What if you took money and you built ChatGPT and you build the next Google, the next Tencent, the next Baba, whatever it might be? That's a good use of money. So leverage is just neutral. The use of leverage is actually the key determinant of how well you do long term. I think that's something that the developed markets and China has also done very well with saying, look, we're increasing leverage, but we're using it productively so that the net output from your wealth or GDP outpaces what you've borrowed. So roughly speaking, on academic terms, if your expected return on borrowing the money is more than your cost of borrowing the money, you've done well. That's kind of a very rough generalization. But aside from IRR, sometimes it's useful to manage your cash flows because sometimes, especially if you run a business, you might need some bridge capital or something in the meantime so that you don't have to go borrow, you don't have to get expensive loans. Having access to liquidity is very important when you run a business, especially if you run a very manufacturing-heavy business. And also, things aren't permanent. There's what we call rollover. Having access to capital is very helpful when you're rolling over your debt from one to the other so you don't get into trouble and not be able to pay your employees or pay your suppliers. So going back to this chart earlier about debt to GDP, you see that, again, on the left, that's the chart that most people worry about, where US debt to GDP has gone from 40 out to 120 or whatever it might be. What about households? Households have actually gone down. US households debt to GDP has gone down ever since Lehman. So it's contrary to what people think about consumers just over borrowing. They've actually been paying down debt versus how much money they're making. So you can actually think of it as the government is borrowing on behalf of the people. And this theme will come back later, especially for Japan. Public debt to GDP has gone up, household debt to GDP has gone down. But not just that, even though households are carrying debt, this is a chart of US household net wealth. It's basically a straight line. They're borrowing more debt, but they're as wealthy as ever because the debt is invested. The debt is used. The debt is not just spent on buying the next iPhone or consuming whatever it is. The debt is being used productively, and you see that through the rising household levels. And that is one piece of the puzzle as to why do they keep spending? Why are they able to kind of keep doing this and never sort of get into trouble? Because net, their actual wealth situation is honestly doing quite well. And you can actually see that on their balance sheet. If you remember the previous chart, that was the government balance sheet. This is the household balance sheet. Their liabilities is nothing compared to their assets. You see about 30% of the American household is in their homes. That's not a bad asset to have. Other financial assets, which is a lot of stocks and all the stuff we discussed, a lot of it is in equities. So if you think about it, as long as the assets are being used productively, your home values will stay, your equities go up. Their assets are growing much more than what their liabilities are growing. And if you look at the liabilities, which are 19 trillion, 2/3 of that is in mortgages. Again, that's probably not a bad liability to have, right? It's people's homes, people borrow for their homes. It's not that bad. It's not like they're borrowing on just credit card buying a new car. And you can see that through the debt service ratio. Even though their debts are going higher, their assets have grown so much more, and the job market has been so decent that their service ratios have gone from 13% At the worst part of Lehman, when they completely went over the skis, back down to 9% in 2022. It's basically a very similar chart. Savings in the US, so excess savings have gone down since COVID, the blue chart, but overall total savings for US households is positive. There's money in the system, but where's that savings coming from? The chart on the right. The blue line is non-farm payrolls. For some reason, whatever it might be, the job market has done exceptionally well since 2021. Job growth have basically outgrown any other indicator from consumption, employment, etc. The US economy has done very, very well, especially post-COVID in the current recovery. And this was a chart that was surprising to me when I first saw it. As you know, mortgage rates have gone up a lot. Mortgage rates are now at 7%. That's very high. The chart on the left is foreclosure. Foreclosure is when you can't pay your mortgage and the bank takes away your homes. We're at historical lows on US foreclosure. So the highs when Lehman blew up, so 4.5% of loans went bad. We're at 0.57 on 7% mortgage rates, which was very shocking to me, but I guess it points to how strong the US balance sheet is, which allows them to be able to carry these type of mortgages without losing their homes. So it all kind of validates this whole idea of the balance sheet getting better despite their liabilities going higher. So going back to the savings, I've called this big brother doing your savings for you. In keeping with the concept that a lot of people think that the developed world isn't safe, especially for North America, what they miss is they have a very different pension system than a lot of us do. A lot of their wealth is actually pre-saved through pension deductions. There's an asset class called pension savings. These are not sovereign wealth funds. They're not guys you read about buying VCs and PE. These are actually just national savings. Teachers, firemen, police, normal people. There's 175 trillion worth of savings pensions globally. That's a massive number. And pensions are ultra long term. They're planning for boomers to retire 20 years forward, 30 years forward, very conservative and very, very large. If you look at this chart, this table here on the right, this is how much national pensions are for the respective countries and as a percentage of the GDP. If you look at the top five, US is number one, obviously, in terms of total assets at 35 trillion. Netherlands, Australia, they're smaller, but as a percentage of the GDP, they're massive. They've oversaved versus what the GDPs are. So in some way, the country is already saving for a lot of the retirees through the public pension system because they manage it so well. Again, share of top AUM, US being number one, no surprise. Japan, as everyone knows, is a big net creditor nation. They're at 10% of the total world pensions. And in fact, they're actually the number one actual pension fund in the world on a singular account. And same with Norway. So Norway, they obviously get a lot of oil money. So their oil money, they basically save on behalf of their citizens by buying assets abroad. So what's really interesting here, and that's not being appreciated, is both Japan and Norway very publicly has been buying US stocks, Apple, tech stocks, Facebook, whatever. They've been very active buying US stocks. So what does that actually mean? It means that because for example, let's take Japan as an example. They won't spend, they keep all their money in the bank, they leave it in yen, they don't want to do anything. The government goes, fine, I'll borrow for you. So that's why debt to GDP in Japan is massive. I'll borrow for you, I'll invest overseas for you on your own savings. They're running a carry trade. The Japan government is shorting the yen and buying US dollar effectively by buying Apple stocks. You save in Japan, great, I'll take your yen, I'll convert to US, I'll buy an Apple stock, I'll let it sit there. You won't invest overseas, right? I'll do it for you. And that's worked really well for them because as we know, US stocks have done very well and the yen has depreciated. So net, the net pension balance versus GDP has expanded. The countries have done a good job saving on behalf of the people, which eventually gets paid back in the form of like retirement benefits or stimulus plans, whatever it might be. So there's this concept of, for us here in China and Asia, a lot of us have to save for ourselves, we worry about our own PA, we worry about our own investments. But a lot of places in the developed world, they don't think about it as much because they have such a massive pension balance that the government invests on their behalf. So you can, so you can see this. What's the point of talking so much about pensions? Well, if you remember, there is about 60 trillion of this total pension balance that literally is a permanent buyer of bonds and stocks. They don't sell. It's pensions. They're going to buy and wait until all the baby boomers retire and die and whatever it might be. That's a really long time. They only buy. So you think about markets that only have one buyer, a massive buyer, they never sell. What do you think happens to stocks and bond prices? They have to go up, right? But there's a permanent buyer. Every month when you make a salary, you put money into your pensions, they go and buy more stocks. There are only a limited number of stocks. So that's when I'm going to touch on this next slide. The point of talking about this, which people don't talk about enough, is not everybody is a rational buy and sell anytime. There are a lot of people who are price insensitive, such as pensions. They're just going to buy because that's in their mandate. So which is why asset prices generally keep going higher, because there's a circular effect. As long as you have jobs, you're saving, you're getting money into their pensions, they're going to buy more stuff. It's very simple. So this was the topic I touched on earlier, which was, we got a lot of QE, we got a lot of money printing, but where did inflation go? Why didn't we see a spike? And what happens when you push the entire interest rate curve lower? What do people end up doing as a behavioral reaction? So same chart you saw earlier. Big expansion, the yellow chart, which is the balance sheet, and CPI is pretty much flat. Balance sheet on the bottom, same thing, expanded. Where's the inflation? So you saw this chart earlier. Just to refresh your memory, I had mentioned that point 3 was the most important. The final person who sells the treasury to the bank and holds $100 in cash, what do they do with it? There are 3 choices. 1, I don't do anything. I leave it in the bank. Cash becomes cash. Literally nothing happened. All you've done is you've grossed up the debit side and the credit side of your balance sheet, but net, nothing has happened. That's not really good. Number 2 is this person goes, okay, well, the seller said, okay, I just sold some treasuries. Maybe I'll go buy some stocks, or go buy some houses, or go buy some cars, and prices will go up. But remember, most of these people are regulated charter banks in the US. They have very, very strict restrictions on what you can do with your reserves. Goldman Sachs can't just go and buy a bunch of properties with the reserves in the bank. You're not allowed to. That's against your federal, same as China. Your regulated banks, to protect the investors, have very tight controls of what you can do with balance sheet. So you end up buying more treasury bonds, which you're kind of just recycling from one bond to the other, right? You're not doing a heck of a lot. What's the ideal situation? What are you supposed to do? The ideal situation is you take the extra money and you lend it out. Oh, there's a startup like SignalPlus. Here's some money, why don't you go borrow it? I'll give you a good rate. Same in China, right? The government is always talking about, can we get smaller SMEs, small companies to get access to credit? Can a person running a business get an easier credit with a bank if there's all this money slushing around? In theory, that's great. What happens in reality? As we know, that doesn't really happen. What did the people with the cash, number 3, what did they do with the money? The chart on the right. They put it back as deposits back at the Fed. You did a big circle. So this chart here shows how much of these banks have left the money back on the Federal Reserve as deposits. Basically, they sold their treasuries, they got their cash, they put it right back to the system, and the cash goes right back. It never actually went to the economy. It's literally in the banking system just going like this. That's why there was very little inflation. But what did it do? Oh, sorry, before that. This is the part I was talking about. This is what we call money velocity, if you remember. It's measured as M2. This is basically saying if you put $1 in the system, roughly how much comes out to the economy. So for the longest time, 1960s to 1990s, 1.8. So you put $1 in the system, 1.8 times comes out. So credit, it's good. It's a good catalyst. But ever since we started printing more money through QE, and the banks decided not to spend the money, and they put it back onto the balance sheets, that velocity has collapsed. Now velocity is like 1.2. 1 is basically nothing, right? You put $1 in, $1 comes out. Like literally, you've done nothing. We've basically, and you look at COVID really took that number down, which basically means QE is highly ineffective in terms of getting credit growth or making people willing to invest and lend more. Because people just, for whatever reason, regulations, or they don't want to get in trouble with the government or get in trouble with bad loans, they decide to just park it back in the system. Literally, printing money by balance sheet expansion is not working. And it's true in the US, it's true in China, it's true in most places. So that's why these days, if you listen to what the central bankers are saying, they don't like QE. QE is politically difficult. People don't like it because you're printing money, helping the banks. You're creating large balances on both sides of the balance sheet, and it doesn't really do a heck of a lot, which is why you can see, as in the discussions, I personally think that QE is gone. It's not going to come back. They might do small ones just to help, but what we saw in 2010 is basically finished. That's not going to happen now for the ongoing era because there's more downsides than upsides. And one of the downsides of QE, what did QE actually do? This chart on the left, all these multicolors are yield curves for Japan, for UK, for Germany, and for US. That box period is the QE era. All QE did was push the entire interest rate curve flatter. Because if you think back to the guy who sold the bond, well, I sold my bond, I got this cash, I can't buy stocks, I can't buy a house, I can't buy a car, I'll just buy another bond. And you cannot just keep buying more bonds. So you've literally took away all the supply of the bonds. Chart on the right, if you guys remember, we had all these negative yielding bonds, these bonds that pay negative, which is like just crazy, because you force the banks to go replenish the asset, but you regulate them, and they're not allowed to buy other stuff except bonds again. You basically wiped out the entire bond supply. And that's why bond yields across the entire curve went to zero. Remember, money didn't go into the system. All you did was you made yields go to zero. But people weren't borrowing more because remember, look at this. The velocity wasn't going up. It wasn't like people were borrowing more loans. Rates just went to zero. That's all you've done. You weren't, that's, if you guys remember, maybe you're too young, but in 2010, 2015, just because rates are zero, you and I can't walk up to Bank of China and say, like, hey, can I get a 1% bond? Like, no, right? You're still going to get like 10%, right? So none of that actually passed through. It's set on the bank. You created giant balance sheets, and you literally ruined the bond market because it's all negative. So that's why it's another reason why it was an experiment, and I think it didn't work out. If the idea was if I do balance sheet expansion and the average person on the street could benefit from having more access to cheaper credit, didn't happen. But you created a lot of negative externalities, such as ruining the bond curve and a lot other things, which I'll cover here. What happens when you make bond rates go zero? If you remember, interest rates are the price of money. You make money worthless, people start doing weird things with money. Doesn't mean you get access to more money, but the money you have in your wallet, you start doing really weird things. You start buying like really long-dated stuff. What's the most long-dated asset you can think about? Real estate. You hold houses forever, right? What happened to real estate prices? Straight up. What happened to long bonds? Long bonds rates went to zero. We saw that, right? What happened to growth stocks? Growth stocks don't make earnings, right? But it's okay. I mean, if for the long run, I can give them 10 years to grid. So growth stocks went up. Overvalued stocks. Emerging markets, same thing. Oh, it's Philippines or Vietnam, wherever it might be. Lots of money went to emerging markets. Brazil, Turkey, because my money is worthless. I need to put it in long duration assets. Insurance plans, company bought back their stocks, and which I'll touch on later, private equity, VCs, and even crypto. Because people say, well, I have all this money, and I don't have all this money. I have the same money I had, but it's not doing anything. I need to start finding ways to get some yield. So they start looking a lot into private markets in VCs. That's why all these startups started becoming so popular over the last 10, 15 years. So the Fed's original purpose of keeping rates to zero through QE was to get more loans to build businesses. That's failed spectacularly. But you've created all these other weird externalities, which was beyond their imagination, but it's now very real and part of our daily lives.